Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Alright, hi guys. So welcome back. The course is finally live, which is good, and some of you are already watching it. Amazing. Again, as I said, I have no idea how this is going to fare on, but one of the things that I wanted to peel back was the fact that you can get pretty good education in investing in finance for free, right? And that's the whole point of this, is I wanted to give back something for free that would help everybody in their journey. I personally don't think there is a lot of that now in terms of financial education. There's just not enough there that is good, that is also accessible. Now, I appreciate that if someone had 10 grand, they didn't necessarily want to spend that. They don't want to spend that 10 grand on education, because essentially, you know, what have they got to trade with or invest with? Right? A lot of the people who've come to learn, and especially are looking, it's because they generally either want to grow wealth, so they don't have a lot of it, or they have wealth they want to preserve, so they kind of already have a lot of wealth and they kind of want to find something to do with it. Now, whilst that demographic, you know, the latter, are probably not going to have a problem with maybe putting 10 grand into education, but that's a smaller demographic, right? The former by far is the largest, and they probably can't afford that. So it makes sense to kind of put something out there that's not going to cost anybody anything, but as they embrace the value, they'd want to learn more and more and more, and as time goes on, they will find themselves becoming very adept at what they do. I'm not going to say down the line that there's not going to be some degree of charge in the future for my time, you know, in terms of developing, but I'm going to make sure I give you such an in-depth, you know, framework that you've never seen anywhere else. And that has been always my intention to do. So this is actually a really big project for me. It's very intense. But as someone who's been in the business for a long time, some of you have followed what I do for a long time, and some of you don't even know me. Again, that's the thing with the internet. Everyone is technically, to a large degree, anonymous, which is great. But one of the things that I have done is, in a way, is give myself a bit of an introduction. In my introduction part of the course, I actually give you proof that I'm a profitable investor. And I'm more than qualified to be talking to you about this. And if you want to be profitable, then you have to be listening to me. You genuinely have to listen to what I have to tell you. Now, of course, if you don't want to be, if you want to stay the way you are and you have no desire to improve, if you can replicate my numbers, because I can assure you, you can't. A lot of people can't at this point in time replicate the numbers that I produce. But if you can replicate those numbers, then fantastic. You don't need to be here. Then you should switch off now and no longer show an interest in what I'm about to say. But if you can't replicate my numbers, and you know inside, it doesn't matter what you show the outside world, but if you know inside of yourself that you can't, and you've been trying for a number of years, and you can't deliver even a 20% return on an annual basis, then you need to be talking to me. That's just the reality of it, because I've shown you that that is something that I can do. And, you know, I know that a lot of people can't even generate a 10% return on an annual basis. I don't care what they show you on the internet. The stats don't lie. And most investors lose money. And we're talking in the region of 70 to 80% of people in the investment arena. That includes both equities, Forex, whatever, don't make any money. In fact, they lose money that they often can't recover. Because if you lose 20%, to recover to even doesn't mean you, in some cases, you have to make more than 20%. So in reality, if you want to become profitable and you've drew down already 50%, then you have to make 50%. And if you're aiming for 50% on an annual basis, for example, you're going to have to make 100% in order to get to that number. So the odds are stacked against most people. They don't have the correct tuition or understanding, and there are not a lot of people out there who are going to give you that. And it's not even a question of money. Some people will take your money and they'll give you nothing. It's just how the world works, right? So sometimes they do have things they could teach you. They do have things you can learn, but some people are just malicious. That's what you have to bear in mind. They just don't care. They're like, I'll take your money and I'll tell you a load of shit, and then you go away and come back and I'll still take your money, right? Because people who come from this space tend to be very predatory in nature. I've spent a lot of time in the professional side of financial markets, and people are predatory. They have some people are soulless, and you have to bear this in mind, right? As a new investor, maybe you've come from a nice industry like engineering or science, where people are nice and friendly and there's a lot of love, but sadly in the financial markets that's not the case, and most people are predatory. A lot of people are they just lack basic human emotion. But in any case, guys, I'm not going to drool on. I'm going to jump into the meat of it, but I think it was important because I know some of you are going to be seeing this for the first time, so it just makes sense that I kind of give you a bit more of a spiel. Okay, so again, you remember the last course we started to talk a lot about stocks. So we're going to talk a little bit more about what must we know before we start investing in this stuff, right? There's a lot of things to know, right? But I'm going to pick on the things that I think we should know about stocks and equities before we start even considering investing. I can't tell you how many people I've seen who've come into investing and they don't know this stuff. They don't know anything. In fact, the only thing they know about investing is that they got a Robinhood account. Someone on social media told them if they bought Apple calls now, they're going to make some money, and they just click the button. In some cases, they make money. In the vast majority of cases, they lose money and they don't understand why, and they think, well, markets are just a scam, and they've been lured in. They become a victim, right? And that's the kind of stuff I'm trying to stop happening, to you. If you're watching this now, I don't want that to happen to you. I don't want you to think of yourself as a victim. I want you to think of yourself as someone who's capable. You just need to learn. And that's kind of that's what we're doing here. But in any case, a lot of people come into this without proper understanding. So let's start to discuss some of the things that we need to know. So float and shares outstanding, right? So the float is generally the number of shares available to trade, right? And the shares outstanding is generally the number of shares that have been issued that are pretty much available, right? So again, when we think about shares outstanding, some of them might not be available to trade, right? But they're outstanding. They're part of the overall shares issued, right? So understanding float is important, and I believe we discussed that briefly in terms of how much share supply is out there should influence how we go in and buy a stock, right? Whether we invest in a stock or we buy a stock or we even trade that stock. A lot of it is to do with the amount of shares available, right? So often, if you frequent social media, you might hear some traders, who've picked up some words along their journey, like low float stocks. Like they might say, well, I trade only low floats. The reason they trade low floats is because they're highly volatile, right? If something has a low share float, then it's going to go up and down wildly, and that opens up the opportunity for you to make several X return. Now, lots of these traders, they operate on the market from the short side, right? So they're short sellers. And we spoke about short selling. So short selling is when you borrow a stock from an investor, right, via your broker, and you sell that stock immediately and collect cash. Now, the idea is that the person you borrowed the stock from is going to want that stock back at some future date. Now, you're anticipating that the price of the stock will fall at some future date, which will allow you to go back into the market and buy that stock at a cheaper price from when you sold it when you initially bought the stock from that individual. And that allows you to give them the stock back and then thus make a profit. And that's the whole point of shorting. So let's look at a practical example. So let's say you shorted a stock at $12, the stock drops to $1. So essentially you borrowed the stock, sold it, collected $12, went into the market, bought it back for $1, and then gave it back to the individual. So you just made $11 pretty much from that whole transaction, right? And really and truly, you didn't really need to spend any money because you borrowed the stock. So the only thing you really required to make the deal was margin, right? Because the broker needs to ensure that you have the solvency providing, well, in the event that that stock does not go down and it goes up, right? So as long as you had margin, then you could have done that transaction and essentially made money for free. Right? Nothing's for free, but just to make the explanation simple, you would have made money for free, right? Because you didn't really need to spend any money. So shorting is obviously very attractive for this reason, is that most people perceive it this way. And also the pace of drop when the stock is collapsing is much higher because there's panic, right? So if a stock price falls, then, you know, it could be the company's looking at bankruptcy, right? So there'll be panic. And if you're short that stock, i.e. so you'd come in and sold it earlier at a hefty premium, then you might not even have to buy that stock back because the company might go bankrupt and, you know, the stock's worthless. So it's very attractive, especially if you know the financial condition of a company is not that great. But then that also brings other things into focus, right? And I know I've jumped a little bit into shorting, but I want to cover shorting now. So I don't really need to get into that again, right? So thus, you know, there are some elements of risk too, right? So, because again, when you consider someone going short of stock, then it's very possible that insiders or brokers or rather the intermediaries can manipulate that stock, right? Because they know so many people are short. All they need to do is pump the stock a little higher, and those individuals will have to buy back at a loss. In some cases, it can be a heavy loss. Now, let's take, for example, the stocks. You short a stock at $12 and it goes to $20 in a week, right? You're close to losing, you know, 100% of your margin, right, at that point. Because let's say you only had a $1,200 margin. It's just an example. Right, and that stock is now trading at $20, then that's already $2,000 for you to buy back that position, right? And don't forget, you only have $1,200, so you're already in debt. And this is the danger with shorting. So again, if someone shorts, they can easily get squeezed out of the market, and that's where the notion of a short squeeze comes from, right? Is when essentially someone is heavily short stock and then the stock keeps rising. At some point they're going to get a margin call, right? So essentially the broker is going to ask that they either increase their margin to cover the loss, or they would have to be automatically liquidated out of that position. And as soon as they're liquidated, that stock could keep on rising, right? Depending on how many people get liquidated. Because in order to liquidate a short position, what do? We essentially execute the opposite trade, which is a buy. Your initial trade was a sell. In order to get out of that position, you have to buy back. So that's essentially a buy order in the market. And that what do buy orders contribute to? They contribute to demand, right? Because when you buy something, you're essentially requesting it, you're demanding it. So the demand for that stock will go up just based on the squeeze. And that's what in the last lesson, we saw that in the slide that we had, in the case of GameStop. Right, so that brings us to another point, which is short float, the number of shares available to borrow for a short sale. Right, so a short float is how many shares are essentially available to borrow, because remember, you don't have the whole pool of shares to borrow. You might have a percentage that's available for borrowing. So let's say, for example, 5% of the overall float might be available for shorting, right? So again, obviously the higher this number, right, the higher the number of shares available as short, also the more effectively people are going to, the more leg room they're going to have to be shorting, right? Because there's a lot of shares to short. So if there's a squeeze, it's going to be big, right? And then if the share float is quite small, then it means that, well, very quickly people can get short, but in my opinion, there's not enough market impacts there. So again, if the shorts need to be unwound, they can be unwound really fast. So again, this is worth knowing this because you know how many shares are available to short. And it could also mean that if the stock is going down, the short float is low, then people can really come in and get all the shares available to short. And then when you go to get shares to short, it's not available, right? So again, for people who short stocks, sometimes they can't get access to the shares to short, right? And that's when you start to hear concepts like locate, right? So some of the more nefarious brokers, and we'll talk about brokers very soon, we're coming up to that, because I think that's very important before we get to technical analysis and all that other good stuff. Like I said to you guys, this whole thing is designed here so that you have a long attention span, and also you follow this and you do as I tell you and you follow the education, because if you don't, I'm 90% certain you're not gonna make anything. Right, so back to what I was saying. So again, when you think about the short side of the whole business, there's a lot of challenges. So if you think about locates, right? So locates are some of the more nefarious brokers will get people to pay for locates, right? They pay an upfront cost in order to get access to shares early, because if they don't, then when you want to short, then you might not have any shares available to short, right? Because everyone has taken up all the good shorts. So that leads to locates, and that's the concept of hard to borrow shares. So you want to short a company that the shares are not readily available, but then the broker has to go and find them, right? And they normally come at a very high interest rate and exorbitant cost in order to borrow them. For the people doing these deals, they're anticipating the stock is going to crash so badly that they're going to probably make enough to cover the cost and make a profit as well. But if it doesn't go the way they think, then you can imagine the locate fees and everything else is going to add up, right? So it's not for the faint-hearted, and I don't think it's something that a beginner in the market should be looking to do. But as you get more advanced, and we'll talk about that through the program, remember, this is a big program. They're going to be weeks and weeks and weeks and weeks and weeks of mentorship stuff. So you'll have an opportunity to see how all of this works. But the thing I want to emphasize is that whilst it looks attractive on social media, that shorting, I made millions, whatever, it is a very, very risky and dangerous business, and it can have extreme amounts of cost. Company financials. Now, it's amazing how many people are stock investors / traders or whatever, and they can't read a balance sheet. Now, for me, I'm not massively into shorting. I trade options as well. And if I'm thinking about being in a short trade, technically, I would execute that on an option, right? Preferably on the sell side. But again, for those who followed my option stuff, and we'll talk about derivatives in this program, I largely sell put options as an income-based strategy, right? Because I could sell calls, because the nature of calls, they tend to lose value. Like, they don't incur, and I don't want to get into derivatives right just now because we'll talk about this stuff, but they don't incur the same kind of behavior as, say, put options, because those risk premiums, like on puts, they get heavily they go crazy because obviously, like I said, when the markets are going down, there's panic. So put options can get really expensive really fast, right? Which causes this kind of, it creates this kind of range, right, where the market goes to extremes and then collapses because we have this positive drift, by that I mean we expect markets to go up over time. So some of the big companies we follow, like Apple, Tesla, whatever, these companies are going to gain value over time. So this has to be factored in the puts. But when they're collapsing, puts get extremely expensive, right? So calls, on the other hand, the markets do rise, but in the short term, they tend to correct a lot more during their rise, which means that selling calls can be quite profitable too, because the call options are going to look like, and I'll show you this when we get to this stage, it's going to look like a downward spiral all the time. So even though the stock's rising, for some reason, when you look at a call option, you get these small spikes and then, this continuous decline in the value of those calls. And we'll talk about this. But again, the amount of people who don't understand company financials is amazing. It's phenomenal, right? And it's like, guys, this is important stuff to know, right? I mean, like I said, I operate a lot more on the long side than I probably do on the short side. And if I didn't want to operate on the short side, I'll look towards put options, right? As opposed to maybe do that as a short trade per se, because I really want to limit my risk, even if I'm going to buy puts, which I rarely do, or I was going to sell calls. I look at it that there's a degree of limitation there, which, and some people argue with me. It's like, well, if you're short calls, it's risky in that. So I don't short calls a lot. But if I was to take a short position, I'd rather do it in the option market. But anyway, company financials, balance sheets, cash flow statements, income statements. For me, the most important is the cash flow statement. Of course, the balance sheet comes next because I can genuinely see the company's cash position, their asset and liability position, right? The income statement is great, right? It tells me what their income is, but the cash flow statement does that too. And it gives me a hell of a lot more information in terms of, is this a company that is collecting a lot of debt? Are they paying down that debt, within their sort of, their trading cycles, or are they increasing their share count by selling shares into the market? So are they consistently needing, in my opinion, to raise money? So there are all these circumstances that I consider, and that's why I look at the cash flow statement and the balance sheet primarily. The cash flow statement by far is my most important because it already tells me the company is making money from an income standpoint, and then it tells me all those other bits of information you don't find in a balance sheet or an income statement, right? And especially because we trade in stocks, and we've spoken about this before, in that companies can increase their share count. They can sell shares to the public to raise money. Now, if they're doing this consistently, you can see that. If they do any share buybacks, which reduce the share supply, and a good example is Apple, right? So again, you don't take my word for this stuff, right? Don't just listen to me. Go out there and look for yourself. You'll see that Apple has consistently been the largest buyer of its own shares, right? So it's been consistently killing the share supply, and that's reminiscent of the value of the stock right now and its general upward trajectory, right? So that information is available on the cash flow statement on site, right? So it's very important to go through the company financials because it allows you to, first and foremost, get involved in companies that are profitable, which for me, I don't care about other people, right? Some people, they invest in the future of a business, right? So sometimes new industries like electric cars, for example, was a new industry, and it didn't really matter if maybe Tesla was making a loss in the beginning. But you have to bear in mind that we're only taking this perspective because Tesla is a big company now. What if Tesla had started and gone bankrupt? I mean, I listened to Elon Musk say that, at one point, Tesla was going to go bankrupt. And as a consequence, they had to accept a ruling against them by the SEC in order to be able to access their funds to continue operations, right? So there were points when Tesla was on the ropes, right? Now, so think about that for a second, right? That some of the companies, if they're not profitable, there's a chance they could go bankrupt, right? Their cash position could change. And if that happens, then you're out of business. So it's best to always invest in the business when it gets into a profitable cycle. Whilst you might think you're going to be late, but, it's of course you didn't get the absolute bottom, but essentially you did well enough, because you invested at a point where it was recognized that this business was going to be a successful business. So high risk, high reward for the people who went all in early on without much evidence or proof. They took a bigger risk, so they got a bigger payoff. But at some point, these guys are gonna pay a hefty price, right? Because investment is not just about taking those big swings all the time. It's about consistency and consistency of growth. Exchanges and filings, right? Again, this is another thing. A lot of people don't know anything about filings, right? So again, stocks, they're listed on exchanges, right? So they have regulation to abide by. So everything they do, they got to file with the SEC, right? So again, there's a website called EDGAR, which is the SEC's website where all these filings can be found. So if they have, for example, 13G filings for acquisitions, right? So if someone acquired more than 5% of the company, they need to file that with the SEC. So that could tip a big investor's hand, for example. They might take a big stake. You might notice that in the filings, and then that might generate some interest for you in that business, especially if they're profitable. So that's one thing. So, and there are other filings, annual returns, and so on. So we'll talk about some of these in detail, but the most important ones anyway. But again, listed companies must file all their activity with the SEC, and they make this public. So knowing what these companies are doing is probably pretty crucial. Awesome stuff. So let's take a look. Let's press ahead to analyzing the stock. Now this this area for me is really interesting because a lot of people have a lot of ways they analyze a stock. For me, there are three things and three things only that matter to me. I'm sure there are other things that matter, right? And look, again, I'm going to reiterate. If you want to go and listen to some guy on Twitter who posts strings and strings and strings and strings of tweets that explain why a stock is going up, or someone, doing a screenshot of Bloomberg terminal telling you why a stock is going up, you go ahead. You go straight ahead. Because I can assure you, you keep doing that, you're going to be in big trouble, right? If you're investing on that thesis, good luck. Right? Some of those guys, no offense to anybody who's doing this, but some of those guys, I know. Some of them I've met. Enough said. Anyway, ratios. How is one financial metric performing versus another, right? So, for example, what's the relationship between debt to equity? So this is important because let's say a company has a lot of debt, but doesn't have a lot of money in order to pay that debt either on a short term, so it doesn't have enough short-term assets to cover short-term liabilities, like a quick ratio, for example. This is going to be flag out alarm bells. Now, for me, I'm very flexible on how you look at this. You might be a guy that's all about debt because you understand the sector, and the sector debt is is allowed. It might be big, or in the sector debt is not allowed, right? So most people are not expected to have lots of debt. So this metric can vary, right? But obviously equity is important. So it just depends, right? So I'm as flexible as you need to be with analyzing the relationship between things. For me, I like to think about the relationship between income, for example, and the price of a stock, or income and the number of shares outstanding, for example. Income for me is a big thing. So I like to see how that stacks up against anything else. And that's major for me. And obviously debt is major, depending on the sector. The companies I tend to look at, I expect them to have a lot of debt. I expect them to have a lot of cash in order to pay off that debt. And that makes those companies very attractive to me. Profitability is the other factor. Is a company making money or selling a dream? Oh boy. There's so many companies out there selling a dream, right? And again, I don't want to offend any other companies, but let's say, for example, Lucid stock. I mean, that's a stock I don't currently like because I think whilst it's fairly low relative to its prior highs, for example, it's selling a dream, right? And unless you are an expert in the battery sector, and bearing in mind there's not enough lithium, and also the technology around batteries is going to improve. If we're going to be able to deal with the change in electric demand that's going to happen, then we need to find better storage capacities, right? Because obviously when you produce energy and you produce it in real time to deliver to the end user, then there are other things like transformers, for example, that you need a lot of, right? So it's not particularly easy to do. On the flip side, if you can store that energy and then deliver it later, which I believe they call buffering. So if you're able to buffer, which you can do with, say, for example, hydroelectric, because a lot of that gets stored. You can do that with solar. So the big thing becomes batteries, right? So battery technology has to improve in such a way where we're not reliant solely on lithium. I believe there's some advances in zinc, for example, so zinc-based batteries and so on. So we need to find batteries that use a more abundant resource, right? And lithium is just not that. And I don't believe there's enough refining capacity for lithium. So these are some of the things that you pick up, right? So it's, for me, it takes away, as a company, you're not making money, which is proof in itself that something isn't quite right. If there's a lot of demand for your resource, why are you not making money? If it's restricted in supply, then you can just charge more, right? So I don't really know why a company isn't profitable. So I don't want to even bother to find out. It's a waste of my time and energy. I just don't want to get involved in. So for me, I need to see the upside. So I don't deal with the selling a dream side. I mean, the payoff is big, right? I mean, people are anticipating, well, if Lucid becomes the major player maybe in batteries, for example, then it's going to be pretty good. The upside is going to be neat. And I believe they also make electric cars and so on. But again, when you contrast them with a company like Tesla, which does make money, has a very popular CEO who has the ability to raise capital, it's a completely different story you're looking at. So I think people are taking more of a gamble if you are trying to move towards selling a dream type business. But making money companies, now that's where it's all at. And there are a lot of companies out there that are making money. And then comes the final side, technical price analysis. Now, again, I don't care about the mumbo jumbo. I'm going to show you guys how to analyze a stock chart, and I'm going to show you from beginning to end, and this is how you do it, guys. I don't care whoever's putting what out there and blah, 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 and all the other bullshit. Because there's a lot of that, let's be honest, right? I'm going to show you how to analyze a stock chart, whether that's a candlestick chart or it's going to be a market profile chart, which we'll talk about a little bit more. And I do have, and we'll talk about some of the more extensive programs I've created about market profile, which are not part of this program, but I'm definitely going to touch on it because that's a very, very in-depth topic, and it's a completely different framework in itself. So I'm not going to probably get into that. But again, it doesn't matter whether you're a market profile guy, you're a candlestick guy, you're a bar chart guy, or you're some other kind of analysis, point and figure, whatever, right? It doesn't matter. I'm going to show you how to analyze a stock chart, right? So the technical price analysis is where we want to look at historical pricing and estimate future performance. That's kind of what we do when we technically analyze a price chart. So we kind of want to look where the stocks come from and then kind of estimate where it's going to be based on what historically people were willing to pay. And that means that you're going to look at some other information like float rotation, for example, which we'll come to when we get to the technical side. We're going to get into that. So that volume price analysis side of things, right? Again, we're going to look a lot more into that, and it's very, very relevant to stocks, right? Because that's what seeps into order flow. People who looked at footprint charts at some point, all of this is just order flow information that has been condensed in one place. Or if you're looking at market profile, you're looking at statistical based price analysis. So they're just different frameworks of analyzing price in reality. In some cases, some analyze specifically price and ignore volume or float rotation. Some specifically focus on volume, like order flow, and generally ignore price as a factor. So if you're trading a ladder, for example, you're just looking at microflows, and you're not really interested in the price you're trading at, because you're looking for signs that there's an extreme amount of order flow coming in, right? So it's just basically people are just messing around with both. But what I'm going to do is create a framework that you can work with so you don't have to flick between both. In the past, when I've educated in these subjects, I've kind of looked at them in a fragmented ways. Okay, I might teach you about market profile. I'll teach you about volume price analysis. I'll teach you, but these are actually part of a collective framework. So I'm going to try my best to bring that together. And if you want to find out a little bit more about each individually, then I have specific dedicated programs to each. And I think this will work better because then investors know that there's a framework and they can just use that framework without having to think a lot about some of the extra detail that you don't need to know. But technical price analysis is important. So so these are the three things that I tend to look at. Now comes the very, very big question, which is, how do I find stocks? Now, in modern day, we have what we call screening, right? So screening essentially means that you pick a criteria of, like what would you want your ideal companies to look like, right? So it could be they're growing income over a period, they have a certain amount of debt, their share float is this. You can even screen based on technical patterns depending on how advanced a specific screener is, right? You've got different screeners and some are more advanced than others, right? And obviously once you get into the institutional side, a lot of money can go into screening. So you might have quant-based stuff. I mean, obviously Bloomberg terminals exist and so on, right? So yeah, in order to screen for stocks, I prefer to use finviz.com, right? It's free, does the job. There's a premium version, but the free version, in my opinion, is quite good. So with Finviz, you can screen for certain criteria, right? So again, I think when we get to homework, we'll talk a lot more about this. And then, of course, there are commercial options. Most brokers have, for example, screeners built in. I am an Interactive Brokers client, so I have access to TWS, and they have an amazing sort of screener, and it's a real-time scanner as well. So scanners, you'll hear them called at some point, as opposed to screeners. Yeah, but again, irrespective of the word you use, TWS has real-time scanners, which allows you to pick up stocks that might be of interest through the course of the day, as long as you've configured your scanner right. And of course, commercial options can be quite expensive because obviously these guys want to compete, so they put lots and lots of features. And sometimes you might not use any of these features, or you don't really need it. It's like overkill. But it's not going to stop these guys selling you this stuff. And so, like I said, this is industries can be predatory. Like people will sell you shit you don't need. It's just the way it is. But finviz.com is perfectly fine. And if you have Interactive Brokers as a broker, and like I said, we will talk about brokers, then TWS is a really good option. So screening is kind of how we figure out what we want and how we want it all to sort of play out. Now, before I go a lot more into screeners, I'm going to take a step back, talk more about filings. So go back to those filings, those exchange filings we talked about. Now, for me, there are three sets of filings that are going to matter, right? And you want to check these at all times. So for me, the quarterly filings, which are also called 10Qs, and the annual filings, which are called 10K annual reports, right? So these are company accounts. So essentially they get filed either every year or quarterly, as the name implies. And that allows you to see the company's performance on a quarterly and annual basis, right? And everything they do, from even employee stock compensation, who's doing what, the predicted future of the company, if they're developing any new products, how many product lines are so. So this is a very detailed document, especially the 10Ks. Some of them could be several pages, hundreds of pages, right? They can be quite big and in-depth depending on the size of the business. The 10Qs are a little bit smaller and give you a more quarterly picture. So if you're a professional analyst and you're a researcher and you do this day to day, then you're going to be looking at 10Qs and 10Ks a lot, and it's going to give you a really good understanding of the business. But I always say, think about this, guys. If you've got 100 companies that you're following in a watch list, are you going to be able to read all their 10Qs and 10Ks? Hardly. I don't think so, right? So, but it's an important thing to know anyway. So especially if you're going to put money behind a company, it doesn't hurt to look at their 10Ks and 10Qs, even if you're going to scan it, right? Again, the SC filings, right? So we spoke about those, right? So filings that are to do with, for example, 13G filings, right? So these are like SC filings that have a lot to do with beneficial ownership, right? So if someone has about 5%, they've got to file these things. Sale of securities, right? So a lot of the time, if you're a small cap trader, and a lot of people will tell you effectively about small caps, that sale of securities are important, because if these companies sell securities, they have to file that they've sold, right? A huge amount of securities. Also, in some cases, they need to raise more money via debt, so they will issue more debt, right? All of this will show up in the sale of securities side. So these three things are really important to look at, because sometimes if you're, say, on the long side of some of these smaller companies and they start to issue debt, right, to raise money, then some of that debt can be convertible into stock, right? And that means that stock can be sold on the open market. So there are a lot of reasons why you'd want to pay attention to sale of securities. So as long as you're monitoring these three filings, right, and I implore you to go to the SEC website, pull up a popular company and look at how many times they sold securities, pull up a less popular company, maybe something that's losing money, for example, and look at how many times they've done sale of security, and look if there anybody having SEC filings in them, and look at their 10Qs and 10Ks and see what they think about themselves. So that's a useful exercise that you can go through. So here's an example of FinViz's screener, right? So you can see here that this is the free screener, and you can see all the different metrics you can screen from. So you can see things like exchange, market cap, EPS growth, quick ratio, net profit margins, short float, long-term equity to debt, right? Return on equity, some technical stuff, RSIs, option positioning, insider transactions, gaps, current volume, current float, number of shares outstanding, their IPO date, any after-hours change, right? So it's a really detailed screener, even country, right? Sectors and industry, free cash flow, any kind of earnings per share growth, right? Any kind of gross margin growth, operating margin, institutional ownership, right? And once you put in the different criteria you want, you can save that criteria, which means you can come back to it at any point in time. So you can see there's a list down here, which will list all the companies that match this criteria. So isn't that amazing, guys? A lot of people now, if you never knew this before, then clearly you've already had some value. But there are a lot of people who are in this business that they don't know this. They have no clue. Yeah, never heard of FinViz. Nah, I don't know. I follow some guy on Twitter. He says I need to buy this package and that package, and it will show me stocks I need to own, and I'm going to be a millionaire in a week. Good luck. Right? I can assure you this is just predatory stuff. All right, so again, for some homework, go to FinViz, choose your own personal screen. Right, so essentially create a personal screen of companies that you would like to see based on those metrics. You don't need to learn everything about the metrics. You just need to understand that you want as much positive stuff around the metrics. So for example, you want something with good gross margins. You want good net margin. So you want it all to be positive. So you create a pretty decent screen that is highly positive, and then see what you get out of it. So just play around. Second part of the homework, go to Google, search the Edgar filings. This is the SEC's filing service. See how it works for yourself. Take a company from your screener list, punch that in, and then look at some of their filings and see if you find anything there unusual. Sometimes you're just browsing and you see very unusual stuff. I found some really great investments, by taking something out of my screener, looking at the SEC filings. All of a sudden, something really interesting jumps out at me, and I'm like, oh my God. And then it turns out to be a massive play. It's what it is, guys. So those are your two exercises that you can go away for your homework and then come back and, we'll see, if you want to DM me something, whatever you can. I will eventually put up my Discord server details, which should be elsewhere in the YouTube channel, but some of the other videos. So if you want to get in touch with me directly, that's how you do it. But amazing stuff. Again, another course down, or another section or module. Remember, guys, this is going to be huge, right? I can assure you, no one's giving you this, right? It's going to be huge. So, yeah, till the next lecture, guys, enjoy. Adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?